Let's bring in Jonathan Sheridan over at FIIG Securities, get his thoughts. Firstly, on the St. Louis Fed's member, what did you make of Bullard's comments about potentially continuing the bond buying program?
Yeah, good morning. I think it's interesting that he said that. He's been one of the noted hawks, so he's been very much in favour of terminating QE and raising rates. That being said, as you said, he's a non-voting member, and as we know, it's all about the consensus. And you know that we've got a couple of dissenters who are more hawkish, but Janet Yellen's the note of, and that's the way the FOMC seems to be going at the moment. Look, I think they were stabilising comments. You know, perhaps there was a bit of internal discussion at the Fed about how they might stabilise things after the volatility we saw over the last few days, you know, which was just completely extreme. If you're into the maths, it was sort of 8 standard deviations, the move in bond yields that one night when they spiked down in yields to 186 on the 10-year. He's a non-voting member, as I said, so maybe that was just a calming influence that the Fed tried to put out in a bit of a public message.
It's interesting as well because of the volatility that we've seen in markets, there's been talk not just of extending, as we heard from Bullard, the bond buying program, but indeed ramping it up. QE4 has been mentioned in some parts of the market.
Well, that surprises me. I think you know, the market's jittery. You're going into the territory of QE forever there, you know, and that just can't happen. You know, the Fed's balance sheet is, what is it, $4 trillion, I think now. Just unwinding that position, it's going to take them probably 15 years, you know, at least, and that's going to have impacts on markets that no one can foresee. So the whole point about the orderly wind down of QE this time around is to try and keep markets from getting too volatile. And yet we've seen, you know, that the volatility's come all at once, and I don't think it's a coincidence that it's come just a couple of weeks before the QE program is expected to end.
Jonathan, is there a worry that the Fed, the US, and as a result the rest of us, that we're in too deep when it comes to stimulus, that despite the huge amounts that's been pumped into the system by the Fed, they're not seeing what you would have thought is anywhere near the kind of growth that they'd have hoped for, and that winding it back is going to be more than a little disruptive, not just to global markets, but potentially their economy?
I think that's one of the key risks. I mean, really, if you drill down to the heart of the matter, all that's really happened is that the debt that was washing around pre-GFC on corporate balance sheets is now on public balance sheets.
Yeah.
You know, it's got to be paid back somehow. And I think, you know, when we've seen previous times in history when we've had debt burdens like this, and I think probably after the Second World War is a good example. You know, it took 20 years for them to inflate away those debts effectively. So that's why they're worried about inflation. Really, I think the underlying issue here is not that they really want to pay them back. I think they're looking to inflation to inflate them away over an extended period of time, and that's why they all want inflation. But
they're not getting it, are they?
No,
they're getting the opposite.
That's right, they are. I also read an interesting piece saying that, you know, of the jobs growth we've seen in the US economy, something like 70% of that has come out of Texas on its own. So, you know, that when you drill down, you know, into these figures, I guess you can drill down as far as you like, but that's a really interesting thought. If you know, 70% of the US jobs growth is coming out of one state, it doesn't paint a very rosy picture for the rest of the country.
And you wonder, particularly being Texas, what kind of jobs those are. What does it mean for US Treasuries? What does it mean? I mean, I remember speaking to you yesterday morning after that, what was just, as you say, quite an incredible movement in the US Treasury market. Do we see more of that kind of almost flash-like movements, or is that just a bit of a one-off?
I think that was just a big capitulation on the part of, you know, probably a large hedge fund. You know, they obviously had huge positions that were many times leveraged, and they decided to unwind them all at once. I'm not sure we'll see, you know, flash moves like that. But volatility will certainly be higher than we've seen in the past, because the traditional broker-dealers who would absorb that inventory and then manage it off their own balance sheets just aren't there anymore. Or they're certainly not publicly there. You know, clearly the bonds and all the equities have to be owned by someone. But those institutions that own them are more private now, and basically, you know, we're looking at funds here. So we're going to have more volatile times. You know, leverage is up around the world because there's been all this cheap money. So when money's cheap, people borrow it, you know, and you just got to be careful about the companies that you invest in and look carefully at their metrics. And there'll be spots of opportunity for everyone, but volatility is here to stay for, well, at least the short to medium term, I think.
With that in mind, then, where, from your perspective, do you see value in global markets?
So really the place that we're focusing on for domestic investors is actually getting into US dollar denominated assets. We've done a lot of work recently analysing the way the US dollar performs in terms of against other currencies, in terms of the relative outperformance of the US economy over the last 50 or so years, and on average it increases in value about 19%. So we're really looking to get our clients into US dollar denominated assets, obviously picking those carefully, as I said, as you would with any bonds. And locally, we still think inflation in Australia is going to be an issue. If the global economy slows, then the safe haven trade will be to buy the US dollar, and the Aussie dollar traditionally suffers, which will mean imported inflation, because we're effectively a nation of importers apart from our raw materials. So locally, we still think that there's legs in inflation-linked products.
Oh, good stuff, Jonathan. As always, thanks very much.
Thanks, James.
We're going to